All right, so the market had a lot going on this week, and we kind of finished the week with a little bit of a bang. The last risk event possible that could come out came out today in terms of whether or not China was going to actually go see whatever they were going to go see in Montana that they had hastily scheduled pretty much yesterday morning, supposedly, canceling that today. And despite the fact we didn't have the rally in anticipation of this event, we had a little bit of a sell-off, and we'll talk about what that means and why and what it means that the market's response to all of this week's risk events, what that means about our posture going forward. So I'm going to break down a lot of different technical charts as well to support our expectations going forward from here, whether or not they support it, and see if there's any red flags that are popping up. We'll talk about what's driving the price action, and then our trade idea of the day. We'll take a look at what do we do whenever we're getting some volatility but not really going anywhere. So let's go ahead and get started. Today is Friday, September the 20th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and start off taking a look at the market forecast here with the S&P on the S&P 500. So late little sell-off yesterday. Interesting that we didn't really we sold off on news that Chinese trade delegates were not going out to Montana, and yet we didn't really rally on that news that they were. In fact, it was, from what I understand, tentatively planned yesterday morning, and then finally, and before you even heard from the president, it was taken off this morning, so in one day. So it's interesting to see quite the reaction. It kind of tells me, number one, that it's mostly expiration, penny expiration price action. It's also because it's quadruple witching, right? Where just about everything expires, including all those quarterly options. And then you also have headline-driven algorithm trading, which that's not a long-term thing. And a lot of people are comparing it to over here. This is a little different. The president last time used the Fed's rate cut to announce more tariffs, essentially, or ramp up the tariff schedule on China. With the considering that we were near all-time highs, and he wanted to, in my opinion, wanted to push the Fed to be more accommodative than they were. That's what that move. We didn't get that volte here this go around. Here he actually did come out immediately after with a negative tweet towards the Fed president, but then walked that back by the market close yesterday, and said that it's actually they're actually doing pretty well. So I don't expect that we'll get the same, where the president uses the cover of all-time highs or close to all-time highs and Fed rate cuts to allow for bearish news to come out. Otherwise, we'd have seen it. In my opinion, we would have seen it like immediately after the market closed, and we didn't. So this is about as bearish as we got, and it was actually well before the market closed, and it wasn't announced by the president. So take this selling with a tremendous grain of salt. In fact, again, coming one day off of a potential cluster, we almost got an overbought cluster, which would have been a really bullish cluster had we gotten it yesterday. Had we finished anywhere close to the highs, because we were flirting with that overbought cluster all day yesterday. Very, very good sign at the beginnings of an intermediate trend. But now with this little pullback, yes, that's not a bearish near-term move. That's a little bit of a red flag. The fact that the near-term line did not really get above 80 and went above 80 by it dipped its toe in the water, and only stayed above 50 for a couple of days. That's not bullish at all. We have a bullish posture, but that's not a bullish confirmation signal from the near-term line. That's relatively weak. So that's a red flag. The near-term line has pulled back down, so has the momentum line. So technically, by definition, this is a bullish intermediate confirmation signal, kind of a buy the dip signal, where you have a strong bullish posture with the intermediate line above 80, an oversold momentum line being below 20, and then the near-term line also being below 50. So if this turns out to be to turn up to the upside Monday, as you would expect it would, based simply off this pattern, then we might, again, that would kind of just show how temporary today's news and market reaction was, and nothing changed, nothing even changed in regards to the trade relationship. Now, if news comes out over the weekend, then something, the market might have been preparing itself for that. But otherwise, consider it just a superfluous market reaction that was mostly headline driven. And that's pretty much it. As well as expiration driven. Now that we're through that expiration, expect the market to kind of take off on its own. And considering the bullish pattern, again, rising green line, dark green shading, and we're getting closer and closer to rising market sentiment. At least it's still above 50, but we're getting closer and closer to rising market sentiment. I mean, that's a pretty decent bullish pattern. And then if you look at the Russell 2000, which, remember how we talked about how the Russell 2000 hadn't really dropped enough yet on the near-term basis, right? It had dropped over here more. It finally caught up to the upside, but then the S&P pulled back initially more than the Russell did. So the Russell actually had to catch up with some near-term pullbacks to the point where it's down here, dipping its toe underneath 20, and like on the S&P, setting up for a bullish intermediate confirmation signal off of this pullback back to the upside. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, there's one down below the video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells me two things. Number one, you got something out of our video today. You liked our video. Number two, you want us to do it again Monday. So it's our way to get feedback. It's our survey, so to speak. If you like us to do these videos and you like us to do it again on Monday, give us a click down there. One click. It's really easy to do. You can do it right now while you're watching. Also, while you're down there, comment. What did you get out of our video today? Was there anything that stood out? Anything that you would let others know that are coming for the first time why they should check out the video as well? Follow me join our daily market outlook email list. There's a link popping out up there on the top right corner of your screen. Remember, the Friday list includes 4 watch lists, the overbought and oversold clusters for both the daily and weekly clusters. So subscribe to that list for those daily watch lists, as well as a timestamp summary of this video. Follow me on Twitter for more content in between the videos from day to day, and join our daily market market outlook community that we've created on Facebook. All right, also, we invite you to subscribe to our website. If you're watching here on our blog, right here at the top, as you scroll down anywhere on our site, there's this blue button to subscribe. There's over 1,600 now subscribers, market scholars. We invite you to join our community. You can do that for free there. Of course, we do offer different pay subscriptions levels. Our monthly subscription here with the free trial is listed right above the video, which includes our daily market outlook live that we do at 3:30 Eastern time that I do before I do these market outlooks. So check that out. We put the trade idea for the day on before the market closes, as well as we go back and look at past trade ideas that we've done in these videos, and we manage them all the way to the close, which you don't really get too much on other videos, right? People will tell you what trades to make, but then they don't manage the trades going forward from there. And so that's the point of that video, and that comes along with this monthly plus subscription. We also invite you to engage with us on social media. We try to make it really easy for you. Again, the benefit of doing that is it tells Twitter and Facebook that you want them to put our content at the top of your timelines, because they might not put our content in your timeline at all, simply because, depending upon how many people you follow and who you engage with the most. So we try to make it easy for you. Just hit this little heart, opens up this new window, and you can like today's Market Outlook tweet. Click this image, it takes you to your Facebook account, and you can like today's Market Outlook Facebook post there as well. All right, so let's get back now to the charts, and let's take a look at the long-term chart. So how did we finish this week? So again, we would have had to really close down low, down to 29.56 to get a lower shadow. So we ended up here with another bullish Hakunashi candle. We got a slightly higher high,
But now next week's open, if you look at the Hakinashi, the open here at 29.56.54 and the close at 29.97.26, divide that by 2, that gives us an open next week at 29.76.90. So to kind of put that in context, we're trading already at 29.92. So depending upon how we open over the weekend, if we open right here, we'll have another bullish candle already for next week. And see what the regular candles look like. You can see, we've had a good bullish run. Not surprising that we pause a little bit. And you can see in the past when we've done that, we pause, we can continue to move higher. We come up, we pause, we can continue to move higher. So we'll see if that ends up being the case this go around. Let's take a look at the 3 green arrow charts. Not surprising, we finally got 1 red arrow. So the histogram has come all the way down. The question is, will it come all the way down towards the 0 line and then bounce back up? We're not going to get another surge like this. So, if as we do move higher, we will now just get these little short pops. That's what it does, right? When the intermediate runs start, we get big surges, and then everything afterwards is just grinding. We get a big surge, and everything is just grinding. A big surge, and now everything is just grinding. Of course, when you go too far down, you can go down here and still be, still hit the moving average and bounce. But for the most part, if you go too far down, now you get the intermediate pullback. And so the expectation is we'll probably do something like this, right? Where, whether the stochastic pulls down below 75 or not, or whether the intermediate line pulls back below 80 or not, we are down towards 0, which means the MACD is down sitting on its moving average. And the expectation is that we'll kind of move along the moving average. And the moving average, you can see the orange line can kind of trade around these elevated levels for a while. And even then, at current levels, right where my cursor is, if you go back, you can see the moving average has been higher. So it was about this level here. And I compare this point to this one. I've done that before. I've also compared it over here too. And you can see really, if I put my cursor where the orange line is now, that's about where the orange line was. And it actually, after the MACD hit the red arrow, it bounced up. It continued to move higher and stayed up at these elevated levels for a while. We might get a little bit of a pullback there, but you can see it can stay here as the intermediate trend runs slowly but surely, and that looks to be the case now. Even with this late sell-off, we're still just flirting with the 8-day moving average and not even really close to the 17-day moving average yet. Remember, 29.76 is where the Hakinashi Open will be. So even if we come down to the 17-day moving average on Monday, Tuesday, and we don't go below it, then we won't get the lower shadow on the Hakinashi candle, and we'll have a good chance that we finish next week with a bullish candle as well. Again, 4 to 13 weeks is the expectation there. All right, if you take a look at the intraday charts, you can see that, again, all the selling occurred pretty much right when this announcement came that the Chinese, and in fact, we kind of had a little bit of a dead cat bounce. The cat fell off the roof, it bounced, and it came back down to the ground. You can see this, as we talked about actually over here on the FOMC meeting, this 298 level is a support level on this kind of intraday level. Again, you break through that, and we're coming down to 292. So, maybe stopping for a breather and to take some pictures at a scenic spot at 296 along the route. But the reality is there's not very much volume until you get back down to 292.5 into that area. So, I don't expect us. We could, because of course anything can happen, but I don't expect necessarily that we'll make that big of a decline. Remember, again, 29.76. That's pretty much, the SPX is going to be, and you won't see the volume here, but 29.76 is right, pretty much just underneath that low point, right, kind of in the middle of this range. So if you compare that to SPY, that's right underneath this low point here, right in the middle of this. So it's basically pretty much at the bottom of this volume thing. So we either will hold this or we don't. And the expectation is you typically expect volume to hold, you expect support, to hold until it doesn't. If you look in, at today's trading range. And again, consider all the risk factors that came out this week with the repo market on the bond market and the overnight market, cash market, excuse me. What happened in Saudi Arabia to begin the week, the FOMC, the China news here at the end of the week. You put all of that into the equation, and you can see that we had, pretty much a little bit above average volume because of triple witching at 100 million. The range today, smidgen above the average. Again, most of that coming here in the afternoon. But look at the week. The week, with all this coming out, and most of this volume, again, a good chunk of it coming here at the end. But, we barely had, if we had slightly below average volume, and if you look at the range for the week here, we had 5-point range on SPY for the entire week. Remember, we had a 3-point range today, a 5.22 range here on the entire week. Just to put that into context here, 5.22 is a pretty decently high range for a day. If I were to go to a weekly chart here, the average right now is 8 points. And the volume, you can see the average volume for a week is at 354. We were below average volume with a pickup at the end with the quadruple witching, and way below average. So 5.2 is way down here for the weekly chart so again, it puts in the context that just how, in my opinion, how bullish the markets are. That a lot of risk factors that had we been more mature on this intermediate trend might have created more of this type of selling where we were more mature previously. But considering that we have already had some volatility and we're just coming off of that, shows that the market is set up in an environment where it can trend for a while at least to the upside. Finally, let's take a look at the volatility index and see how that was impacted. We got all the way up to 15. We got all the way up to the midpoint of the bullish, basically the sweet spot for the bullish range of volatility. So again, that should also put into context how, if we were flirting up here with the 90% level or even maybe breaking into the neutral range, then you'd be a little concerned about what could come out of this weekend. But the reality is the options market's not concerned at all about what can impact. We just basically came up towards resistance, and now the expectation is for volatility to slowly creep its way back down and stay in the bearish territory here. In fact, if it wasn't for this rally, at the low point here today even, we had the lowest close. We were going to have the lowest close for the week on volatility for quite a while on the VIX, and so that changed. That changed obviously with this little rally at the end, but still you can see how bearish we are. In fact, if you look at the September range of about over 8 points here. Again, we usually spike in volatility when we have coming off of months with really small ranges. We haven't had a month with really small range for a while, so we'll probably start to gradually work our way down through to the end of the year before we get really small again. All right, so before we look at what's driving the price action today, and even though we've already discussed it a little bit, but we look at intermarket relationships and look at our trade idea of the day. Just to summarize the technical outlook, we had, we're in a slow bullish grind. We had a little bit of volatility here at the end of the day today, but nothing that changes the trend. And a lot of these charts still can maintain some pretty decently bullish patterns, even with, this near-term pullback that we were kind of expecting sometime this week anyway, and it appears that we got it. It didn't look pretty, but when you consider all the risk factors that were out there this week, it probably wasn't going to look pretty. But the fact that we held up so well and we're still holding up above, certain levels on these different charts we looked at, and it all just kind of shows that there's an expectation that a lot of this selling post Montana, not going to Montana, coming out of that event risk here at the end of the week, a lot of this volatility is basically much ado about nothing, and we'll just rally. We'll just continue to grind our way back to the upside once the market shrugs this off. Again, barring anything coming out that can throw all this out the window over the weekend. but get back to its normal grind here as early next week, especially with that bullish buy the dip pattern that you're seeing on the market forecast. So what do you think? Do you agree with that assessment? Do you disagree? If there's anything that you see on the charts that would suggest otherwise from what we just came up with here, share that with us in the comment section below. Share that with the market scholars community. Oh, sorry. And as always, there's that link popping up right there. Click that link. It opens up a poll. Then you can hit either agree or disagree. And like I said, if you disagree, which is perfectly fine, everybody's got their opinions, but don't just share your opinion. Share what backs up your opinion, right? Share, like I've done with you here, share what you're seeing that would suggest otherwise. All right, now let's jump back into what's driving the price action today. And let's look at the different asset classes and how they're performing. You can see that gold, and let's just take a look first at how this week has performed. By the end of the week here, you can see we had a little bit of a bounce back rally. Here we go, 16th through the 20th, and we'll go to about a 15-minute chart. We had a little bit of a bounce back rally in gold and bonds. Remember, they've been really bullish. In fact, if you look at their charts here, well, let's finish looking at this chart. So crude oil started the week strong, obviously well off of its Monday morning highs, but still finished the week with the best performance. You have long-term bonds and gold rallying too at the end of the week. In fact, pretty much all week long for long-term bonds, which means the yields are continuing to fall there even through the FOMC meeting. Only just a brief dip, FOMC dip, and same thing with gold, just a brief dip. You can see the dollar remains strong, so the dollar rallied out of the FOMC and held those gains. But stocks were down heading into it. We rallied coming out of the FOMC and then pulled back down. And international stocks doing the worst, and small cap stocks. So basically, we started to bounce. It's kind of a technical pattern where you have the safe havens were so bullish. As the market starts to bounce, they sell off the most because they're the most overbought. And now, with their pullback, in fact, we can take a look at the chart here for like TLT for an example. It was so bullish, we sold off, and we bounced back up. Now, is this a bounce back up to a new trend? Most likely not, right? You can see we are below a moving average that is at best flat. It gets us up 0.04 of a point. But we're below it and close to moving back down. It's light green shading, with what could very well be really easily next week, not Monday, but probably Tuesday or Wednesday, a red line. So that's kind of the expectation. The same thing with gold is that we sold off, we bounced back up. How much further is this going to go up? It's dark pink shading. But now the question is, if we continue to rally to the upside, a lot of that's going to be dictated by what the dollar does. Right, the dollar has been really volatile up and down, but still, it's holding the breakout, right? That's the thing, is all the other times it's broken above 98, immediately comes back down, immediately comes back down, immediately comes back down, immediately comes back down. This is the first time we broke through, came back down, but held 98 so far. A lot of volatility. So, there's a big battle here for dollar bulls and bears. The expectation based on past precedent is the dollar to be bullish coming out of this. And so that would mean, from a gold standpoint, that you would expect gold to be relatively weak, along with bonds, especially if stocks were to take, to continue this intermediate run that this is barely starting. So that's how the major, you can see from a yield standpoint, the yield had rallied. They've come back down a little bit, back below this 1.8% level after kind of hitting this 23% retracement, getting up and into this retracement zone, the bigger zone, right, the dotted line zone. That will be significant, and of course the next resistance will be, and probably where it ends up stopping, will be at the bottom of the more common retracement zone, which is between the 38 and 62% levels here. And this is the big drop yields have had from that peak in last October all the way to the low point we just barely had at the beginning of the month. I do actually expect yields because I do think we're getting another cut by the end of the year. Again, they allude to the mid-90s all the time. The mid-90s had 3 cuts. The 10-year note is still below the Fed funds rate. Remember, the Fed funds rate is at 1.75 to 2%. So when you look at the midpoint of that range, we're still below that. We're just barely sitting at the bottom end of the actual range itself. So I mean, there's still room for the Fed to cut rates again one more time, and that would be, we've seen that before. That would not be surprising if we got that again. And then what has happened in both those mid 90s instances, and remember the thing about the mid and late 90s is that there was such a tremendous gap there too between U.S. Treasury yields and German Bund yields. And so coming out of that mid-cycle adjustment, yields took off to the upside. And we all know that the stock market took off to the upside too in the mid to late 90s. Now, I don't think we're going for a multi-year bull market here that ends in a tech bubble. We're already pretty high valuation, but we were pretty high valuation too coming out of those mid-cycle adjustments. So it's a very, very similar environment. The question is what it will look like this go around, because we have different drivers this go around. We don't have the JDS Uniphases of the world or the Qualcomms that are so, that were unicorns then. Now we have different. Was it 5G? Will 5G drive this up? Whatever the case is, it's a similar macro and interest rate environment to what we've seen before, and the Fed continues to allude to it. From a sector rotation standpoint, if you take a look at how the sectors here have performed this week, you can see healthcare, not surprising, utilities ramping up today with yields dropping. Utilities making a run up. Staples, real estate also outperforming SPX, even though they had small losses. Energy and materials outperforming as well with the dollars. Remember, they're dollar sensitive. But your big sectors here, your more cyclical areas, and including industrials and financials, all lagging the most. They all pulled back the most. They're most sensitive to headline risk, and they ended up pulling back. Interesting pattern with XLV. Let's take a look at this chart here. XLV. You can see an interesting pattern is we're kind of breaking out here to the upside. Nice little bullish move. We made a trade on a stock in the health sector. AbbVie and Biogen, another stock that appears to be kind of turning things around after significant underperformance for quite a while. Look at the nice strong volume that we had in this stock here today, continuing its trend higher, going through areas for a lot of these stocks where they really sold off here. So once they get into those areas, it means pretty easy and strong moves to the upside. You can, like I said, see the same thing on Biogen, which is obviously had its own factors. But you break up into this area here with a bullish pattern. There's no volume up here. It's a strong run. Now it's a big run, so it wouldn't happen all in one day, but it'd be a nice, steady, easy trend for that to occur. So healthcare's had a nice little run. If you look at the sector comparison here and just look at this week by itself. Yeah, let's go down to September and go to September. Let's go to 15 minutes again. There's your real estate and utilities kind of holding up, a little bit of a risk-off week, but then look at healthcare. Healthcare was relatively weak and finishing strong, along with energy being a loser here. Again, dollar sensitivity, keep that in mind, and there's your cyclical areas. Again, simply you have area that these were your really bullish areas. They've pulled back on the beginnings of this intermediate run. Now they're bouncing this week off of kind of a sharp pullback. Now the question is, are they going to maintain the previous bullishness, or more likely roll back over with some oversold areas in the short term bouncing back up again? That would obviously be the expectation. So our trade idea is actually kind of taking advantage of this up and down moves that we've had, and considering that we're kind of getting towards the end of earnings of the quarter, which means we're coming up on earnings season here in mid to late October, which kind of gives us a few weeks of lacking some catalysts, barring what any news that can come out regarding the trade wars, but lacking some individual catalysts on a lot of these stocks. So one of the stocks I wanted to take a look at is Salesforce. Has been sideways for most of the year. It had some volatility here along with the rest of the market. It's bounced back up. It's got a bullish pattern going here, rising moving average, dark green shading. You look at its 3 green arrow chart. You can see that it's got 3 green arrows again with a pretty decent move in volume today. Look at that on the 2-line version, and you can see that we're crossing above the moving average. If we had the initial surge, it's pulled back. Now we're kind of getting a renewed 3 green arrow signal again. It's not as bullish as it could be. There are some things like the Bollinger Bands in particular. You got some headwinds of the point of control right above us. You got this big time volume node that you can see. We built up a lot of, built that up so big because that's where we've been trading for most of the time. So you can see that it's got its own center of gravity here, kind of attracting the stock to it. So it's kind of hard to break out of it, especially with the bandwidth as low as it is. And when it gets really low, it can stay low if there's no catalyst to push us out, which is not coming up here until after actually November expiration. We just barely had the earnings announcement here, and you can see we had the big move, and we pretty much have traded in the range of that day's reaction to earnings this whole entire time since. So that usually sets us up for, one more thing too, is the directional index, movement index. And you can see that we have, the DMI plus has popped up above 20 and close to popping up above 30, which is great. That we haven't popped below 20 yet on the orange line, which means the ADX is below 20 and likely staying there. And so that we can trade that sideways action by saying, okay, well, let's come over here and we'll sell the 145, buy the 140, sell the 165, buy the 170, and trade the stock to stay within that range. This is what it looks like. Again, like I said, we've already put this trade on in the Market Outlook Live segment, but it can stay here. It's a normal position sizing because the stock is got a really, really low movement right now, and we're a couple of months away from earnings. So there's the setup here. We're right in the middle of the range as it stands, not surprising. The volume, the upper band is kind of protected by all the volume that's above us here, and all these highs, and the center of gravity is kind of going to keep things in this area, ups and down around it. But the bottom is protected by a bunch of touches here around this area all along the way in the past year. And whatever volume, what little bit of a volume node we do have on this chart outside of this big Death Star is right in that area as well. So we got some protection both to the upside and to the downside. And like I said, this big center of gravity right in the middle. So that makes up, that sets up for a iron condor type situation where I can sell both the call vertical and the put vertical to get the credit that I want for the 30% return on risk, knowing that if it does break out, then either on the upside or the downside, then I can try to limit my risk to the return I'm trying to get. That way I'm position size around a 1% loss, but if it makes the move and gets up to the upside, then I'll take a third of that for a really small loss, and I can move on and try to make that up with another trade somewhere else. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Let's keep this conversation going over the weekend. There's a link popping out in the top right corner of your screen that will take you to our forums. Open up any new thread with any questions or comments you have on anything we talked about in today's video, or for anything we didn't talk about that relates to the topic. If I didn't cover it and you want my take on it, let me know in the threads there. Again, by going to that link. Remember, you have to be a free subscriber to participate in our forums, at least a free subscriber. But I showed you early in the video how you can do that and join our growing community there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content. Join our community on at marketscholars.com, as well as the Market Outlook community we've created on Facebook. Have a great rest of your weekend, everybody, and we'll see you all on Monday.